What up, traders? What up, investors? Ken here from Dyslexic Investor, and we're going to be looking at a very interesting part of a podcast that I truly love. It's called the All In Podcast with Jason Calacanis, David Sachs, Shamal Papatil, and David Freeberg. Great stuff. Absolutely check it out. I'll clip this little bit. It's about David Sachs explaining why the Fed is wrong. We're going to be listening to his clip, and then we're going to be jumping into the chart to kind of see on how that interacts with what's going on with the crazy Fed statements and changing of basically their positioning and what happened within a three-week time frame. So I'm going to get my face out of the way and enjoy the clip.
Triggered it this week. I predicted, and you guys had similar predictions on just a few weeks ago, that this would be the 2022 would be the year of the correction, and it really began in November. You had the Fed. You had Fed governors make some hawkish statements about inflation not being transitory, about the need to raise rates. Then we had the Fed Open Market Committee meeting. This was I think around December 15th, and they announced what they were going to do on rates. And now this week, the minutes of that meeting were released, and it basically it said something that was completely different than what they announced to us just 3 weeks ago. And so the market basically just seized up and went into convulsions. And specifically, what they said, in mid-December was that they were going to taper faster. They were going to end QE at the end of Q1 instead of Q2, and then we're going to have quarter point rate hikes in Q2, Q3, Q4. That was the plan for 2022. And then there was additional guidance that they were expecting 3 more quarter point rate hikes in 2023 and 2 in 2024. So that was sort of the 3-year plan that was laid out. Then we find out from these minutes, and I guess these minutes weren't leaked or anything. They published them after a 3-week revise and extend remarks type period. But what we find out is that what they were talking about was having a rate hike as soon as Q1, and not just ending QE, but actually shedding assets, which is like the opposite of QE. So instead of basically going out there and creating money,
shrinking the balance sheet.
Yeah, shrinking their balance sheet. So instead of going out and buying bonds, they're going to sell their bonds, which will reduce the money supply. So look, if that was their view 3 weeks ago, why didn't they announce it? I mean, my problem with this is it makes the Fed look like they don't know what they're doing, because they announced something just 3.5 weeks ago that's completely at odds with the statement they just put out. So either something changed in the last 3 weeks and there's been no data, or they don't know what they're doing.
All right, so after that statement from David Sachs, you can see that again, just kind of give you a look at from the chart. So again, that Fed was between, their meetings was the 14th and 15th of December of last year. So that's basically these 2 days right here on the chart here. Again, we're looking at the NASDAQ. So the NASDAQ is more the tech-savvy stock indicator ETF. So those are those 2 days. And then we had that market sell-off because people were kind of reacting to it. And if you remember, so this was a Monday, Tuesday, then we had a Wednesday, Monday, Tuesday, Tuesday, Wednesday, Thursday, and then that Friday, we just saw a rip, and it was absolutely insane. And anyone was like, oh, it's going to be great. The market's in full swing. And then we kind of hit some hesitation because we hit those all-time highs. Always when you get to those new all-time highs, you kind of get a little hesitation, and no one wants to be the first person out the door or touching the water, that kind of scenario. But then we have the lovely Fed minutes come out this week on stating, actually, QE and all that kind of stuff, we're just going to go and just cut that, and we're just going to start raising rates substantially faster. So this is basically just forcing those growth stocks, or those stocks that don't have like a large multiples on like a 2 or 3, even 5 years of sales. Those multiples could be 50, 60. Those are going to probably be re-rated to below 20 potentially, because again, on the amount of investment capital, because it's going to cost more to have money. Like again, when interest rates are so low, borrowing is very simple, very simplistic, very easy. But once our rates going higher, that growth kind of kicks in because of inflation. You have to counter it. This will create this kind of potential market triggering within the growth stocks. So looking for the NASDAQ, what we could see here, we're seeing a little bit of a potential triple bottom here. We'll see on how the markets open up this evening at 6 p.m. Eastern Standard Time, on how the futures will interact, and especially how the next week will counterbalance on the potential news, because it does take time to kind of flurry these things through. Because again, if you look at a lot of these larger growth stocks, they have been absolutely obliterated, like David Sachs said initially if you watch the full interview of the All In podcast. So just want to give you my understanding of what could be going on here, and especially looking at the chart here, especially on the QQQ, we have seen multiple times some support coming into the 144 EMA here, when we saw some very large pullbacks. Again, this is a daily chart, so we saw a very large pullback. That was that basically this time, like a little bit less than a year ago, we had that regrowth rating kind of thing, where people were afraid of rate hikes and everything, and we came down pretty substantially here. We came down, what was this, about 12%. And then we had that a little bit of a head fake here, and then we had another scare due to the virus and everything kind of coming through here in September, and we had about an 8% pullback. As of right now, I don't even think we're from the all-time high. I think we're maybe at 5%. We're at 7%. So if we come back down to this 144 EMA, that would kind of put us in around that 9 to 10% potentially. So looking for that, again, being a pretty significant floor here. There is a synthetic bottom here, as I call it. Again, the ticks on the line don't really mean much of anything, and it's all about price and volume. We're seeing a lot more volume coming in at those price levels, so that could synthetically mean there are support. Doesn't mean that it has to be support. So seeing those potentially break through, we could easily see that 144 EMA here, which is this little dotted green line, fall in for some support for the NASDAQ. Again, NASDAQ is an overall, if we're talking about more individual stocks, we can kind of go through that on a fine-tooth comb. Go ahead and join me tonight at 8 p.m. Eastern Standard Time for a live stream. We'll be going down into more individual stocks. And if you're interested on what trading account I use Tastyworks, which is the affiliate link down below. So again, that I do get a slight chunk if you do create an account within that affiliate link. Again, guys, thank you so very much for watching. Please don't forget to like and subscribe, and I'll catch you guys on the flip side. Peace.